Hey, Realty Rockstars! Welcome to our guide on how to analyze real estate markets, a critical skill for anyone looking to succeed in real estate investing. Whether you're planning to flip houses, build a rental portfolio, or make strategic purchases, understanding the market is essential. This guide will walk you through each step, starting with high-level market indicators and gradually moving to more specific, actionable analysis techniques. High-level market analysis. The first phase of market analysis involves understanding broad, overarching factors that influence a real estate market's health and potential for growth. These factors are essential for determining whether a market is worth pursuing before you dive into the specifics. Population growth. Start by examining the population size and growth trends in your target market. A growing population typically indicates a strong demand for housing, which can drive up property values and rental rates. To analyze population growth, Google search city name population to get a quick overview. This basic search provides an immediate snapshot of the city's current population and recent growth trends. U.S. Census Bureau. For more detailed demographic data, the U.S. Census Bureau provides comprehensive information on population size, age distribution, household income, and migration patterns. This data helps you understand who is moving to the area and why. Wikipedia. Often, Wikipedia pages for cities include population trends and growth rates, offering a broader historical perspective. Understanding population trends helps you gauge the market's potential for long-term growth. A city with a rapidly growing population is likely to have a higher demand for housing, making it a more attractive market for real estate investment. Conversely, a shrinking population might signal economic decline, which could negatively impact property values. Job growth and diversity. Job growth is a key driver of real estate demand. A strong job market attracts new residents, increasing the need for housing. However, it's not just about the number of jobs. Job diversity is equally important. A market with a variety of job sectors is more resilient to economic downturns. To analyze job growth and diversity, citydata.com. This site provides detailed information on the types of jobs available in your target market, the largest employers, and the overall employment landscape. This information helps you assess the market's economic health. Local business journals. Search for city name job growth to find reports and articles on employment trends in the area. Local business journals often provide insights into upcoming developments, major employers moving into the area, and other factors that could influence job growth. Google search. Use simple queries like city name job growth or city name employment trends to uncover local developments and new businesses moving into the area. A market with diverse employment opportunities is less vulnerable to economic downturns, making it a safer bet for real estate investment. Conversely, markets dependent on a single employer are riskier, as the closure of that employer could significantly impact the local economy. A downturn in that sector could lead to widespread job losses and decreased demand for housing. Median home and rent prices. Understanding the median home price and rental rates is essential for evaluating a market's affordability and potential returns. This information allows you to determine if the market aligns with your investment strategy, whether you plan to flip properties or generate rental income. To analyze these metrics, Google search city name median home price and city name median rent price for quick results. These searches provide a general idea of what to expect in terms of costs and returns. Zillow and Rentometer. Use these platforms to get detailed insights into current home prices and rental rates in specific neighborhoods. Zillow offers comprehensive data on home prices, while Rentometer provides rental rate comparisons based on property type and location. Knowing the median home price helps you determine whether a market aligns with your investment budget. If median home prices are significantly higher than your budget allows, you may need to consider markets where prices are lower. Similarly, understanding rental rates is crucial for evaluating potential cash flow from rental properties. A market with high rental demand and competitive rental prices can lead to positive cash flow, making it a more attractive investment. Appreciation rates. Property appreciation is a critical factor in making informed real estate investment decisions. Appreciation rates indicate how much property values have increased over time and can help predict future value growth. To analyze appreciation rates, National Association of Realtors, the NAR, provides reports on home price appreciation trends across the U.S., offering a national perspective. Local real estate agents. Ask a local agent for data on how much properties in the area have appreciated over the past few years. Agents can provide insights into specific neighborhoods and property types that have seen significant appreciation. Google search. A simple search like city name, home appreciation rate can provide quick insights and direct you to relevant articles or reports. Markets with strong historical appreciation rates offer greater potential for long-term profit, making them more attractive for investment. However, it's essential to understand the factors driving appreciation, whether it's due to genuine demand or speculative bubbles. This understanding can influence your decision to invest, as speculative bubbles can lead to volatility and potential losses. Crime rates. Safety is a top priority for most buyers and renters, making crime rates a crucial factor in market analysis. High crime rates can deter potential tenants or buyers, leading to longer vacancy periods and lower rental income. To analyze crime rates, citydata.com provides detailed crime statistics for specific neighborhoods, including information on types of crime and trends over time. Local police websites. Many local police departments publish crime data and trends on their websites. These sources offer the most up-to-date and localized crime data. High crime rates can significantly impact the desirability of a neighborhood. Investors need to consider whether the area's crime rates will affect their ability to attract tenants or buyers. Understanding crime trends helps you avoid areas that may present challenges in attracting tenants or buyers, ensuring your investment is in a location where people feel safe. School quality. Good schools are a significant factor for families when choosing where to live, making school quality an important consideration in market analysis. Properties in areas with highly rated schools often command higher rents and have lower vacancy rates. To analyze school quality, greatschools.org and schooldigger.com. Both websites provide comprehensive school ratings, reviews, and performance data, allowing you to assess the quality of educational institutions in your target market. Google search city name school ratings will also yield useful information, including local opinions and recent developments in school quality. Areas with highly rated schools tend to see higher property values and rental demand, making them attractive for long-term investment. Investing in areas with good schools can provide a buffer against market downturns, as these neighborhoods tend to remain in demand even during economic slowdowns. Mid-level market analysis. Once you've established a general understanding of the market through high-level analysis, it's time to dive deeper into specific metrics that reveal the market's current dynamics. This phase involves analyzing both demand and supply to assess whether the market is viable for your investment strategy. Market demand, using list source. Market demand refers to the level of interest and activity in a particular area, especially from investors. Understanding demand helps you gauge how competitive a market is and whether it can support your investment strategy. Here's a step-by-step guide to analyzing market demand using ListSource. Step 1. Go to listsource.com, a powerful tool for building targeted lists based on specific real estate criteria. This tool allows you to drill down into the data to see exactly what's happening in your target market. Step 2. Build your list. Select Geography. On the Geography tab, start by choosing the geographical area you want to analyze. You can select your entire city, specific zip codes, or even neighborhoods depending on how narrow you want your search to be. Watch the property count. As you select your geographical area, pay attention to the orange counter that shows the number of properties available based on your search criteria. This real-time feedback helps you understand how many properties meet your initial criteria. Step 3. Filter by property type. Select property type. Under the Property tab, choose the types of properties you're interested in. For example, single-family homes, condos. This helps refine your list to include only the relevant property types for your investment strategy. Include specific types. You can include additional property types like townhomes or mobile homes if they align with your investment goals. Step 4. Identify investor activity. Select absentee-owned properties. To gauge investor demand, under the Options tab, filter the results to show only absentee-owned properties. Absentee ownership often indicates that the property is owned by an investor rather than an owner-occupant. Include corporate ownership. If you're interested in properties owned by corporations or LLCs, make sure to include corporate-owned properties in your criteria. This helps identify areas where significant investor activity is taking place. Step 5. Analyze recent sales. Filter by last market sale date. To understand current demand, go to the Property tab. Filter the properties by the last market sale date. Set this to show properties sold in the last 6 to 12 months. This time frame gives you a clear view of recent investor activity in the area. Adjust as needed. If the results show too many or too few properties, adjust the time frame or narrow down the geography to hone in on the most relevant data. Step 6. Determine the number of investor purchases. Review the total count. After applying the filters, review the total number of properties that meet your criteria. For example, if your search shows that 900 properties were sold to investors in the last year, this indicates a healthy level of demand. Assess demand. A higher number of investor purchases suggests strong demand, while a lower number may indicate a less competitive market. Use this data to assess whether the market can support your investment strategy. Step 7. Identify hot zip codes. Sort by zip code. Before finalizing your list, sort the properties by zip code to identify which areas have the highest investor activity. This can be done by selecting Purchase List. Don't worry, you're not actually buying anything yet. Go to Purchase Partial List tab, sort by zip code. It will show the top zip codes where most investing is being done and the most transactions are happening. Export for analysis. Click Export. Export this sorted list to Excel or another spreadsheet tool. This allows you to see which zip codes have the most investor transactions, helping you pinpoint the hottest areas for investment. Step 8. Use the data for strategic planning. Identify target areas. Use the data to identify which zip codes or neighborhoods you should focus on for further analysis or marketing efforts. Areas with high investor activity are often prime targets for investment, offering more opportunities for deals. Build a buyer's list. If you decide to purchase the list, you now have a powerful resource for building a buyer's list of active investors in your market. This can be particularly valuable if you're wholesaling properties or looking to connect with other investors. Understanding market demand through these specific steps helps you gauge the level of investor activity in the area, indicating whether the market can support your investment goals. High demand often suggests a competitive market with rising property values, while low demand might indicate fewer opportunities or a slower market. 8. Market supply. Using list source. Market supply helps you understand the balance between available properties and demand, which is crucial for making informed investment decisions to know if there's enough buyers or renters to fulfill your transaction needs once you're invested. Here's a step-by-step guide to analyzing market supply using list source. Step 1. Return to list source. If you've already built a list for market demand, you can return to list source and adjust your filters for supply analysis. If you're starting fresh, select your target geography just as you did for demand. Step 2. Use zip codes identified in demand analysis. In the Geography tab, start by inputting the zip codes you identified as having high investor activity in the market demand analysis. These are the areas where you're most likely to find investment opportunities. Step 3. Filter by property type and ownership. Select property type. Just as with demand, choose the relevant property types, e.g., single-family homes, condos, that align with your investment strategy. Filter for absentee owners. Again, focus on absentee-owned properties. This filter helps you identify properties that are not owner-occupied, which could be potential investment opportunities. In the Options tab, it's best to exclude corporate-owned properties, as absentee owners are your best potentials. Step 4. Analyze equity levels. Select equity as a percent. To gauge the likelihood of owners selling, in the Property tab, filter properties based on equity percent levels. Properties with higher equity, for example 40 to 100%, are more likely to be sold, as owners may have significant equity built up and could be motivated to cash out. Adjust equity range. Depending on your strategy, you can adjust the equity range. For example, targeting properties with at least 50% equity might increase your chances of finding sellers who are ready to negotiate. Step 5. Filter by length of ownership. Select length of ownership. In the drop-down menu, use the length of residence filter to identify properties that have been owned for a long time, typically 10 years or more. Long-term owners may be more willing to sell, especially if they've built substantial equity. Combine filters. Combine the length of ownership filter with the equity filter to create a more targeted list of potential sellers. This combination helps you zero in on properties that are both likely to have significant equity and have been owned long enough for the owner to consider selling. Step 6. Review property count. Check total properties. After applying your filters, review the total number of properties that meet your criteria. A high number of a few thousand or so indicates ample supply, while a lower number suggests a tighter market with fewer available properties. Adjust filters if necessary. If the count is too high or too low, adjust your filters by narrowing or expanding the equity range, changing the length of ownership, or focusing on different property types. Step 7. Analyze the data. Assess supply levels. Use the filtered list to assess whether there's a balanced supply of properties in the market. A balanced market typically has enough properties to meet demand without an oversupply that could depress prices. Determine market competitiveness. If supply is low relative to demand, the market may be competitive, with rising prices and limited availability. Conversely, an oversupply could indicate a buyer's market where prices may be more negotiable. Step 8. Consider additional filters. If you're looking for specific types of opportunities, such as distressed properties, you can apply additional filters like foreclosure status, tax lien status, or price ranges to further refine your list. Customize for your strategy. Tailor the filters to your specific investment strategy, whether you're looking for fix and flip opportunities, rental properties, or wholesale deals. Understanding market supply through these detailed steps helps you gauge the availability of investment opportunities in your target market. A well-balanced market with adequate supply can provide numerous opportunities for investment, while an oversupplied market might offer more negotiating power, but could also signal potential risks, such as falling property values. Specific market analysis. The final phase of your analysis involves getting into the specifics of property types, prices, and potential margins. This detailed analysis helps you identify opportunities within the market, particularly in terms of flipped properties and fixer-uppers. Baseline pricing for flipped versus fixer-upper properties. Establishing baseline prices for flipped and fixer-upper properties is crucial for understanding what constitutes a good deal in your target market. This process involves comparing recent sales of renovated properties, flips, with properties in need of renovation, fixer-uppers. To analyze baseline pricing, Redfin. Use Redfin to search for recently sold properties in your target zip codes. Look for properties that appear to have been flipped, for example, renovated interiors, updated features. Step 1. Identify the purchase price and sale price of flipped properties. This data reveals the margins investors are achieving in the area, helping you set realistic expectations. Step 2. Compare these prices with similar properties that have not been renovated, fixer-uppers. Understanding the price difference between these properties helps you estimate renovation costs and potential profits. You can type fixer-upper into the keywords field, and it will probably give results of properties that are distressed or in need of repair and would make good flip candidates. Step 3. Calculate the difference to understand the potential profit margins for flips. This calculation should factor in renovation costs, holding costs, and any potential appreciation. With this method, once you've gained a clear understanding of property prices, you can also evaluate whether properties in the area will generate enough positive cash flow by comparing current rental rates with purchase prices. By analyzing the balance between these factors, you can determine whether the potential rental income will provide sufficient cash flow to justify the investment. Baseline pricing gives you a clear understanding of what investors are willing to pay for both fixer-uppers and renovated properties. This information helps you set realistic expectations for your own investments, ensuring that you don't overpay for properties or underestimate renovation costs, and if the area you're researching fits your profit and margin requirements. Once you do this process in various areas, you will get an idea of which markets have better profit margin and cash flow potential based on buying, selling, and rental prices. The more markets you analyze, the better your chances of finding the perfect investment opportunity. By following these steps, you'll be well equipped to analyze any real estate market and make informed investment decisions. Remember, the key to success in real estate is thorough market analysis. Don't skip these critical steps if you want to become a Realty Rockstar. Share and subscribe.